everybody. It's Maynard, Mike, and Colin back with Close of Business Tuesday. I always say it's an exciting show because I like to think we always have one. Today, I think we've got an exciting show, and I think it's mandatory listening and watching because the topic is super serious. You guys have seen the SEC came out with some guidelines around climate-related risks, disclosure, and I'm sure you've seen it talked about in a number of places. We're really lucky today to have two senior partners of Baker Botts and a good friend of ours, Dan Ramito from Pickering Energy Partners, to talk about this. Travis Wofford is the Vice Chair of Global M&A over at Baker Botts, and Scott Janot is head of their ESIR practice. And they're going to come at it from a number of different angles. But gentlemen, let me just stop and say it's awesome to have you here.
Thank you for having us.
Appreciate it.
All right, well, let's jump in. Mike, never a dull moment. I guess today, Tuesday, the screen is a little greener. People thinking we might be making some progress in Ukraine, but why don't you tell us what's happening?
Yeah, Maynard, as we've been saying over the last month, it's been really volatile, but we really haven't gone anywhere. I'd say if you look at the commodity screen in the last 2 days, the thing that stands out is crude oil. It's getting a slap worse than Chris Rock at the Oscars. It's down about 10 to 12 bucks over the last 2 days or so, and so continue to be volatility with that, and maybe some peace talks in Ukraine. As it relates to the equities, I think the thing that happened this week, big equity movers were LNG type stocks. You saw Next Decade was up about 50%, Tellurian was up about 25 or 30%, Cheniere was about flat, and it was really because Biden was talking about commitments for LNG to Europe in 2022 as well as out to 2030, and they're talking about 15 billion cubic meters or BCM, and that's the equivalent of around 2 or 3 BCF through the rest of this year, which looks to us as wholly impossible because U.S. Facilities are really running at max capacity. So you'd have to obviously see some barrels that are going from Asia redirected to Asia into Europe, and that's a possibility, but that's not something the LNG guys are going to do. That's going to have to be something that comes from Asia. In regards to basically the longer term plan of 50 BCM, which is around 5 to 6 BCF a day. That's doable because you're going to have probably anywhere from 2.5 BCF a day to maybe 6 BCF a day of facilities that are basically permitted, that are under construction over the next couple of years. So 3, 4, 5 years out, that's easy to get to 50 BCM, which, like I said, is around 5 to 6 BCF a day. And so we think that's a wholly credible plan there as well. I think if you look at LNG projects over the next that are sitting simply on the board right now that have permits but just are not financed right now, it's equivalent of almost 30 BCF a day. And so just assume half of that just gets done, maybe in the next 7, 8, 9, 10 years. You're talking about U.S. LNG exports of close to 30 BCF a day. Put that in perspective, the U.S. is about 100 B a day market. That would be almost 30% of exports. So it's a really, really big number. And so the last thing I really want to talk about is if you look at the different curves for natural gas and crude oil, they look just totally opposite. Obviously what you see with natural gas is a curve that's sort of flattish to maybe in modest contango, but that contango has really improved over the last year or so, which is why those LNG exporters are going to really be able to finance those projects. And the last thing is crude oil. One of the things that we've seen at crude oil is that crude oil is in massive backwardation. It was around $10 a year ago in backwardation, and now it's about $30 in backwardation. And so, some of the hesitance of these E&P producers to really commit to, CapEx is because that curve is really, really in steep backwardation. And we see that curve come back down on, Europe, starting to stabilize, Ukraine starting to stabilize, and maybe crude gets back down in the high 80s or something of that nature. And the curve starts to flatten out. I think there's prospect that you start to see U.S. producers start to spend, but that's really kind of more of a 23 type exercise for us. So that's what's going on in the markets right now. And so, like I said, the volatility continues. We expect the volatility will continue over the next 6, 8, 10 weeks or so.
It's just an observation, Mike, but it seems like the market is cheering really loudly around these LNG stocks, and that seems to be like maybe too loudly, and then it seems to be too ready to believe that we might have the makings of a solution in Ukraine. What is it about this market that's just trying so hard to make money here?
Well, I think what it really boils down to is in the last couple of years, Europe has really fought gas as a transition fuel, and now they're really buying into that as a transition fuel, and so we are basically the market that has the gas. Qatar has the gas, and the U.S. has the gas, and all we need to do is get out of the way. The permits have been approved. The question now is just getting the financing for these things. getting the logistics, getting the infrastructure in place. And that's where the federal government can help out. If we get that out of the way and we commit to that, then we can really, really grow exports over the next 6, 7, 8 years, which solves the problem with Russia. And so I think that's the issue that's going right now, is that a lot of policy changes have really occurred, not in the last 6 months, but it seems like the last 6 weeks and really the last 6, 7 days.
Well, I think this is why today's discussion is going to be so fantastic, because we're talking about how to finance a lot of things, but particularly out of public companies and what some of those risks might be. Colin, what do you think today, my friend?
Well, you may have seen that today the U.S. Treasury yield curve inverted, specifically between the 2-year rate and the 10-year rate. And historically, that has been a fairly accurate indicator of economic recession. Our message would be, though, to remember quantitative easing. And by that, what I mean is the Fed continues to purchase massive amounts of securities, and that is affecting the forward interest rates in that curve. And so as the Fed has made policy mistakes that have gotten them so far behind in terms of interest rate movements at the front end of the curve, and now the market is kind of making that motion for them, they're colliding with their own strategy at the back end of the curve. And so to use a metaphor, we have the Fed afraid of its own shadow. Maybe a second metaphor, they're chasing their own tail. And so while certainly there is some recession somewhere out there, it is the nature of cycles after all, this particular indicator is actually more verification of just how far behind the Federal Reserve has gotten in terms of all of its strategies. And it is a measure of the overly technocratic nature of the Fed, that they think that they're looking at a valid price signal in a price that they themselves are manipulating, which says it all. I realize that's probably a little technical for those of you who don't live and breathe fixed income, currency, and commodity markets like myself. So let me show you a table to make it a little bit clearer to understand. And you may know that at the end of every FOMC meeting, the group, in an effort to be transparent, lets us know what each of their forecasts are for the projected path of the Fed funds rate going through time. And so that enables us to calculate what the group's view is after each of the quarterly meetings, looking out for a forward moment in time, the end of 22, 23, 24, the long term. And so what I would do is direct your attention here that a year ago at the March 17, 2021 meeting, the group thought that the Fed funds rate would be 0.19% at the end of 2022. The meeting they just had last week, they now think, it will be 2.05. So you can see this huge increase in their expectations, and that most of it happened just in this past quarter. This is the Fed catching up with all the rest of us who've known for quite some time that the inflation was not transitory. Now, what's important about that is, think about what I said, the 2-year versus the 10-year. So if we look out into the 23 or 24 horizon, we get numbers closer to 2.8. And yet the Fed's long-term expectations have remained very well anchored around 2.4, in part because they want everyone else's views to remain anchored around a number close to their inflation target of 2. They've acknowledged that their new policy since August of 2020 is to allow some overheating to the target following periods of undershooting. And so that's why you get this 2.4 number instead of 2.0. So look at what that means. What it means is that as the Fed chases inflation, by definition, if it continues to tell us that its view is 2.4, or it manages its purchases of securities, including fixed income securities, treasuries in particular, aiming towards an inflation target somewhere in that vicinity, of course, you're going to get a number that eventually has a higher rate at the front end of the curve than at the back. This is an overly technocratic process where what's really happening is this 2.4 number is too low. The long-term number should be somewhere around 3 to 3.5, in my personal opinion, maybe even higher if you want to debate it. Now, if you acknowledge that logic is true, what it means is that the real yield curve, the unobserved yield curve, is not inverted at all. In fact, the 2.8 or 2.9 that's still in the future, remember we're at 2.39 in the 2-year today, is certainly lower than where the long-term yields would be. If you doubt that we need to have a Fed funds rate much more in the 3, 4, 5% or higher vicinity, looking out to the mid 2020s. Let me remind you that the US public debt outstanding stood at $30.9 trillion at the end of February 22. And the US federal budget deficit in the COVID affected year was 16% of GDP. And maybe that made sense in that COVID affected year, but it was still 12% of GDP in 21 and will remain elevated in 22 and probably into 23 as well. So this is what is in part creating the inflationary pressures. We have policy mistakes on both the monetary side. We have fiscal decisions that are inflationary by definition, and throw on top of that the outrageous invasion of Ukraine by the Russian despot, and we get oil prices above $100. Now, what is important to know about what's happening in crude is we had a pullback toward $100 crude today, with reports that Russia will, quote, fundamentally cut back, end quote, operations near Kyiv. So clearly the Russians have gotten bogged down, motivated to perhaps regroup and have some conversations with the Ukrainians. We'll see how much of this is real and how much of this is a tactical ploy. But at the end of the day, looking at the June 22 NYMEX WTI crude oil futures market and options thereon, we have seen the value of $100 calls drop precipitously in the past two trading sessions. In fact, the calls at 12 o'clock noon Eastern time on Tuesday, March 29th, were exactly the same premium as the puts. And so while a couple of days ago, there may have been an argument for a producer to sell some of the $100 calls, use that premium to buy some of the $100 puts, lock in $109, looking at a May 17th expiry for CLM2 options, that really has sort of begun to erode as a viable strategy. And if you're going to hedge, you should just do it directly through the futures. And then finally, I want to share one other chart with you, and it's this one called 3 hedges for US dollar inflation. We've remarked now since May of 2020 that our preference for hedging US dollar inflation would be in crypto over gold. That continues to be validated by the data. Gold has basically been flat since the Friday before the Russian invasion. Notice that Bitcoin is up 19%. Solana, a crypto we've not talked about before on this program at least, is up 26%. And what I would say about that is two things. One, full disclosure, I personally trade Solana and Bitcoin. So buyer beware on everything I'm about to say. I myself have live positions in those markets. But the way that I would think about what's happening incrementally is this week, Russia said it would accept Bitcoin for all oil purchases. We'll see what does or does not happen. In the same week, Greenpeace lambasted the Bitcoin community for its environmental footprint in terms of power consumption. And so this is adding proverbial fuel to the fire on a debate that's already present in the crypto network, the crypto community. And that is whether to stick with a validation mechanism called proof of work, which is a competitive process. It's very energy intensive. It's where you get that famous power demand from the Bitcoin world, or to move to a validation process called proof of stake, which is a more randomized process where the rewards are not through a head-to-head competition. It's basically through a randomized nod. And the reason why that's important is it's less secure to use proof of stake. There is a greater potential for the system to be hacked, but it is way less power consumptive. It is way faster, and it is way cheaper. And that Solana curve tells you a lot. That Solana is clearly rocketing up in terms of preference among crypto traders, taking some market share away from Bitcoin. And we notice that the Ethereum network, the Ethercoin in particular, is also evaluating whether or not to move to a proof of stake mechanism.
Well, I think that's a great lead into today, because these are my words, not necessarily yours, Colin, but it's a little bit like you said, we left the other program going and it's having unintended consequences while we're focused on the current program. Guys, let's talk about what's happening at the SEC. And my context there is, there's a broader discussion going on in Washington about, is Washington enabling disabling or neutral when it comes to more oil and gas investment, more energy investment, more domestic production. These guidelines that came out last week sort of seem like, yeah, we were saying on this side of the house that we're, helping, and then wham, some agency on this side of the house issues some guidelines which they just look like they're going to complicate stuff. But let me not wade too far into it. Guys, it's great. Scott, Travis, Dan, we're delighted to have you guys. I think where we thought we would start is just, okay, what happened? Let's just go over real quickly what happened. Most people have seen it, but why don't we start with you, Travis and Scott, just to level set, what did happen here?
Sure. So the SEC had been promising us proposals on disclosure requirements for public companies. We got them. They were robust, to say the least. It was over 500 pages of the guidelines themselves, as well as hard requirements, analysis, and costs.
This is double-sided, but this is what 500 pages of disclosure ruling looks like. The team was upset. I used a lot of toner on this. It may impact our ESG report, but I printed that bad boy out.
Yeah, and they had a lot of help in preparing that, and they've already received thousands of comments related to this topic. There will be plenty more. It provides a very robust framework based on the existing TCFD disclosure framework, which is what, when you think about BlackRock and State Street, they've been pushing on a lot of their investments as well. And it requires public companies, to disclose climate-related risks in very minute details. And so what does that really go into? That goes into, well, what is your oversight at the board level and at the management level of your climate-related risks and governance processes within that? How have the risks had, or how are they likely to have, a material impact on your business and your financial statements? You've got to look at that in the short term, in the medium term, and in the long term. The company does get the ability to kind of decide what those categories are. How have the risks, or how are they likely to affect your strategy, your business model, your outlook? What are the company's processes for, as you've gone through and provided this disclosure, identifying these risks, assessing these risks? I mean, just thinking about the type of disclosure that you're going to have to provide in those processes, we'll see what they really want, separate and apart from what TCFD already requires. And then on a line item basis within your financial statements, the impact that these climate risks are going to have on your company. And not to mention the big one that's out there that I think we've been seeing in shareholder proposals for years now, providing Scope 1 and Scope 2 emission disclosure, as well as Scope 3 emissions disclosure for companies where it's either material or they have a disclosed target. And I imagine we're going to be seeing in coming years a lot more companies receiving shareholder proposals on adopting a target so that they will start providing those disclosures.
So one thing in getting ready for this, I don't know to the extent to which people are really aware of this, but the personalities or the players are kind of interesting here. And if you pull up, we'll just got a quick slide for those of you at home. You've got Gary Gensler, who's the chair, former Goldman Sachs guy. So we're all thinking that means a certain kind of market-based guy. But then of the other three commissioners, there's a couple that really stick out. There's Allison Lee, and she wrote an opinion that I think people should read, which is very positive on all this. And then there's a phenomenal rebuttal, if you will, by Hester Pierce, who was the one of the four opposed to this, which I would just say the personalities are interesting, the way in which appointments affect the SEC is fascinating, and then the fact that Hester in particular wrote the piece that she did is really quite something. Dan, let me ask you about that. You saw all these pieces, you've seen everything that's coming out. What was your take on some of that?
Yeah, I think Allison was, I've read a substantial amount of what she's written in the past, and she's done a very good job of outlaying the data quandary that exists within the ESG ecosystem. I think the SEC in many respects maybe put the cart before the horse, because the existing data landscape under the ESG universe is literally all over the place, right? Taking more of an empirical and objective perspective, there's three things that stick out about the existing data in the marketplace that the SEC did not address. Number one, the uncorrelated nature of the data. You have a variety of providers and data aggregators all jockeying for market share and competitive position within the ESG landscape. At best, the correlation amongst those providers, and this is done by the CFA UK Society, is about 30 to 35%. So in other words, you can be amazing with one provider and simultaneously terrible with the other. Mm-hmm. The other component is the lack of standardization from the existing frameworks that investors have already pressured companies to abide by, whether it's SASB or TCFD or CDP or insert alphabet soup here. The fact of the matter is companies have already allocated a vast amount of research and resources towards frameworks which obviously aren't gaining any ground or even being acknowledged. And then lastly, and perhaps more importantly, is if you look at the rise of sustainability reports with publicly traded companies, this trend was well on its way. And what is fascinating about the sustainability reports, particularly as it relates to the evolution, a lot of these companies present them bottom up, taking into account the nuances of the business and then building out the perspective of ESG related materiality from there. When you have the SEC disclosures, they are coming down on saying, just do scope 1, scope 2, scope 3, without defining what scope 2 and scope 3 is. So in other words, the guessing game. And when you get into aspects, I'm sure we'll talk about it, with safe harbor, I'm not a lawyer, I'll let you guys talk about that. I think it's going to create more questions and issues than answers.
I think this was if you look at some of the, you scroll around, I found a YouTube this morning where Gary Gensler is talking about, hey, we're the interaction between the companies and the investors, and we're going to streamline and standardize and make it easier. And he describes it in a way which I think we all have been struck by, these ESG ratings and the difference from report to report. And so there's no question that there's a wide variety of stuff, and maybe standardization would be helpful. But what's interesting, I'll let Travis, you and Scott talk, this doesn't seem to simplify. This seems to introduce a whole bunch of stuff, including potential legal liability and activist shareholders. And we look like this is officially, my own words, we could make it a lot worse than it already is.
Unfortunately, I think that's exactly right, Maynard. I mean, when you think about how climate disclosure has developed over the years, it's done so in the context of a framework that we're all very familiar with, right? So in the context of Regulation SK, we know what Item 101 requires. We know what Item 103 requires. And even, going back into the Obama administration in 2010, we were given guidance that said in that context where you know what materiality is, you know what's expected, talk about climate. Put it in a context for your company, right, and how that matters from a financial perspective. This takes it to a whole other level. I mean, it is sort of the natural progression of what I would call, stakeholder capitalism instead of shareholder capitalism. I know that's a buzzword that's used a lot throughout the industry, but truly it is doing that in the context of potential legal liability, as Travis was talking about earlier. So without that level of guidance and really sort of bolting this on top of what was working, we face a situation where that lack of clarity really does put companies at risk.
And when you're actually going through and reporting on these types of things, you have to abide by some kind of standard, right? Right now, there are a variety of climate reporting standards that are all jockeying for position. The SEC hasn't adopted a single one like US GAAP. Obviously, on the international markets in accounting, you've got IFRS, but there is, as Commissioner Pierce put it, this climate industrial complex right now that's trying to get into the pole position for this, because once they can set the standards, then they'll have a lot of control, but then they can also certify and charge on top of that. Obviously, ESG ratings and the like is in a similar category of that. I do think it's going to be important for a lot of companies, as anybody who's already gone through the process right now, to try and disclose their Scope 1, Scope 2, and Scope 3 emissions. If you look at some of the proposals over the last couple of years, that at the multi-billion-dollar company level, and I'm talking 50 and up, most of them have received a proposal on this already. But it's the $100 million company now, the $500 million company, where maybe it's not material to their business, maybe it's not material to a financial investment in them, but they're going to have to, on a line item by line item basis, check the box on all of these disclosures and live with the cost and live with the uncertainty and live with the legal risk and liability. In addition to the point you made, these stakeholders will probably be coming in and holding people to task for things that might not be material to their business.
And let's be very clear, like this is putting the energy space in the crosshairs, right? I don't think the SEC put these regulations in place and said, oh my gosh, consumer discretionary, wow, like we're really upset with them. Like energy has been in the crosshairs for a long time, and this is specifically aimed at them. And I think the SEC, frankly, did a very poor job of thinking this thing through, because I think there's a broader question at play. It's what role does publicly traded companies have for the US economy? And it was already incredibly difficult to be a publicly traded company. And if you look at the data, green patents and renewable energy is coming from traditional and the energy space, right? And so what this is inherently going to do is going to provide a deterrent for investing in those companies that are already responsible for growing that renewable presence. You cannot have the energy transition without conventional energy, yet one of the unintended, or maybe the intended, but for the time being, unintended consequences is that this is going to be really hard for companies to execute the energy transition. Lack of access to capital, the witch hunt, and if you're not adequately addressing this, or if the SEC doesn't take a step back and really understand the full ramifications, you're going to delay the renewable cause. You're going to delay the energy transition. It's not necessarily thought out. And one other thing to harp on, like the reason I think energy is in the crosshairs is because Gary Gensler is doing a webinar with Ceres to discuss this regulatory consideration. Ceres is a nonprofit group that's had energy in their crosshairs for the last 10 years. One of their missions is to end fossil fuels. So NASDAQ has an interesting piece that they released, I believe 5 years ago, on revitalizing the publicly traded markets. 1999, there's 8,000 publicly traded companies. The tail end of 2019, there's about 4,000, so halved. They took a step back and what is the major cause of that? It's in part overregulation and implementing more politically motivated regulation into the mix.
Mm. There's so much in this. I guess one of the things that that Commissioner Pierce talks about is we're supposed to do policy in Congress and presumably in the executive branch, but we're not supposed to have agencies creating policy. And she makes a great comment about, with all due respect to my colleagues, I don't think we are the ones to opine on the science and the risks of all this stuff. Is this, I know there's a question in here somewhere, guys, but but is this problem, we saw it at the FERC here recently. Of course, Washington has become so polarized. Where we are now, right, one commissioner gets replaced, this whole thing could get thrown out, right? I mean, what can you talk about, guys, what happens next? Because this could be a big legal battle. That we're not, as bad as the news is, I guess the bad or good news is we're not going to roll right into implementation. We're going to have a big food fight about it for a while.
I think it's safe to say this will result in litigation challenging the regulations. And that, unfortunately, has been a touchstone of environmental regulation now for the past, I would have to say 12 years. When I first started practicing law, you could see differences in the approaches that our political parties had to environmental law, but it was largely within sort of the same playing field and in a way that really did stick to the science. Might have different approaches to it, might have more regulation under one administration than the other, But there was at least some guideposts that industry could look at. I think starting 12 years ago, that changed. And when the Biden administration came in and said they're looking at a whole of government approach to climate issues, it's the next logical progression to go to the SEC, to go to other agencies that haven't historically played a role and say, how can they use their power to do this? And we saw it to a degree back in the Obama administration with, for instance, the Department of Interior and the BLM and others regulating what they would classically do on an oil and gas law side, things like waste of oil and gas, but treating that as a regulatory issue for climate. So it's been a progression over the years, but unfortunately, I have to say as an environmental lawyer, welcome to the club, guys. This is how you're going to see it.
And from a securities lawyer's perspective, I mean, we know what the process is going to be. The commission is not going to change their mind, right? That's not going to happen. It's 3-1, and when Commissioner Lee rolls off over the summer, she will be replaced, but we'll get a similar answer. Absent any litigation being successful, it'll go effective in December, and basically a year from now, people will be reporting in 2024 on their 2023. But I think specific to the question you asked, is this the role of the SEC? We know that there are going to be challenges related to the concept of kind of the major questions doctrine. This happens every single time we think that there is government overreach. And with the current Supreme Court, I think we've got a better chance of some kind of limitation here than we might have 5 or 10 years ago. But I don't think the company should hold out hope for that.
To that point, too, I mean, this didn't happen overnight. Investors have been asking for this material for at least the last 3 years, probably 5 years for the larger companies. I think from a strategic point of view, one of the things that may be overlooked is clearly this impacts the equity markets. But if you look at access to insurance, there's regulation in Europe, Sustainable Finance Disclosure Regulation, commonly referred to as SFDR. That obviously impacts the EU, but 4 of the 5 largest reinsurers on the planet are European, and that has a trickle-down effect. So access to insurance is now impacted. You look at FSOC, so Financial Stability Oversight Committee, and their comments on how this impacts access to lending. ESG-related metrics are being incorporated into there as well. So, I'm very much against it, in case that wasn't completely obvious, but I'm also a realist in the sense that this is probably here to stay. So I think if you're opining on what is next, it's you have to prepare for this to impact not just equity, but be very mindful that the access to lending and access to insurance is probably on the not too distant horizon as well.
So, guys, I was thinking, this reminds me of the Sarbanes-Oxley experience, which, to replay the history, you had all those calamitous corporate failures, Enron, et cetera, and then Sarbanes-Oxley was a reaction. This thing is a reaction to, we got a different administration. There was nothing that happened that, you'd want to take a step back and say, what problem are we solving? And I guess the SEC would say the problem we're solving is investors wanted it. Is that?
No, I think that from a historical perspective, people are going to point back to climate change, right? And they're going to say, well, there was climate change. We realized the climate science at the time, and there has been this progressive outreach by shareholders to receive certain information. Now the SEC is going to mandate that effectively for everyone other than smaller reporting companies, but that's really only a small subset of the information they're not going to get. But I think that you're getting at an important point, which is this is not necessarily beyond the disclosure that companies already provide about the finances of the company. There is a social movement associated with this. There was a moment where people realized that climate risk was real. Then there was a movement associated with that. And now there is a machine that is driving this change on an industrial level, which again is what Commissioner Pierce was arguing.
And the unfortunate aspect about that machine is that it's not pragmatic in the sense that they've made up their mind and they are doubling down consistently on policy. If you look at, to my point earlier, where do green patents come from? 25% of green patents come from conventional oil and gas. conventional oil and gas creates more kilowatts of renewable energy than renewable energy companies. They're not looking at the other end. And I think where energy, frankly, conventional energy has fallen short is we have this tendency to rely on the moral case for energy. And while that's 100% correct and 100% factual and 100% accurate, that's not going to appease that other side. The strategy should be, how do we get the pragmatic players on the other end more to the middle? And energy has to do a much better job of releasing data that's material to them, right? The frameworks and the TCFDs and the SASBs are sometimes appropriate, but as you pointed out, for smaller companies, they're probably not. And until you can get to a place to where you're not butting heads on the emotional level and showcasing data on the objective level, it's going to be a challenge.
I mean, this whole thing is so bizarre because, 80% of the energy that went into the production of this report was oil and gas.
Yeah.
So maybe everybody should do
So
a personal...
you're participating to their scope 3.
Well, but maybe...
That's not good.
The SEC is powered by oil and gas. They use it in the building. Like, it's just, it's very frustrating as to where the anti-oil and gas crowd is for another day. There was one thing I saw about the original intent of the SEC risk factors, which is, it was just, hey, you as a public company need to tell us risks. The SEC historically does not wade in and say, on this specific risk, you need to have. So this is very atypical, isn't it, philosophically, for the SEC to be wading in and say, on this risk, we demand this disclosure, because in general, their philosophy is risks come and go, and it's always your obligation to tell us what they are. Or am I oversimplifying?
I think from a materiality standpoint, and you can chime in if I'm missing anything, the SEC does have a history of providing comment letters to elicit additional disclosure on specific risks or other items in disclosure. But there's a difference between doing that in a focused way that's targeted at a specific company and providing blanket line item requirements for every single company on these items. Again, as Scott mentioned, we had MD&A disclosures. We talk about trends. We talk about forward-looking items to the extent that they're material. We have 103 for legal proceedings related to government and other environmental items. And then there's always just the back end. There are rules that the SEC has provided that requires you to make disclosures of any material information that would cause the rest of your financial statements and other disclosure not to be materially misleading. And that exists, and they have provided those comments. Now, some recent comments have focused around, can you tell me why it is that you're providing this information in your sustainability reporting and not in your 33 and 34 Act filings with the SEC? And that's a valid question. But I think that there are also valid answers to that, such as we don't believe that there are material risks to our financial condition or the results of our operations, but they are information that our shareholders have required us to provide.
Scott, I'm thinking the general counsel of any given company, is somewhere maybe pulling their hair out and
looking at early retirement options.
Well, right. Dan, you always deal with the IR team, the PR team, the executive team who's talking about their ESG. Those two constituencies, how is this going to affect their lives? I mean, it seems like things just got crazy complicated for both of those groups.
Absolutely, or as my teenage girls would say, things just got real, right? It's what we're talking to folks about is that, again, this has existed in the context of a framework we talked about before in Reg SK, but also about sustainability reporting and what we've been saying about ESG for years now. I tell everybody that the first time I looked at a sustainability report was my first week at the law firm 23 years ago. Mm-hmm. And I didn't look at another one for 18 years. And the reason for that was they were important, but they were being handled. They were being handled in-house by everyone from their EHS team to the executive team to investor relations, but didn't have the same level of imprimatur that we were seeing on other more formal SEC disclosure. So now you move everything into that arena.
Is that the way to think about this? The ESG report just got put in the 10K.
I think that's right.
Oh yeah, absolutely.
I think that's right.
That's exactly.
And the practical advice we're giving to folks right now is you might want to go read what you've already said.
Yeah. I think the one thing that's not being discussed because obviously this runs front and center, is the SEC's simultaneous focus on greenwashing. And asset managers are just as guilty of it as some of the corporates, to be honest with you. You have asset managers running around claiming that they're ESG focused and they have this laser focus on ESG, and then you go through the prospectus and the mandate, and then you ask them like, well, what changed in the process? They're like, nothing, we just like ESG. And we're like, well, that's not good. And then you look at a variety of ESG thematic ETFs and indices, and you look at either the disconnect between what their ratings are, and we know the deficiency with ratings, but they don't align with what is in that portfolio. And then you look at some of the other ETFs or indices, and they just look like large mega cap tech funds. And large mega cap tech is not immune to ESG concerns any less than an energy company in many respects. So there's a lot of misdirection is not the right word, but I think it's all over the place in the sense that what is quote unquote ESG in many respects you can argue is misleading, because if you look at how the portfolio is constructed relative to the mandates of it, it's an eyebrow raise. It doesn't make any sense.
I was going to say, specifically to your question about like what is a general counsel thinking right now. I'd have a conversation earlier in the week with somebody who said, so how practically am I going to have to deal with this? And I said, well, look, your regular financial statements that we review every quarter and at the end of the year, now you're going to have climate-related disclosure in there. And you're going to have to get with your auditor and make sure that they're okay with that. And they're going to have to write an audit opinion on your financial statements. And if you like having the discussions about significant deficiencies and material weaknesses and things like that, now imagine if your auditor gets to stick their nose into what you believe about your climate risks.
So the word, exposure, whether you're management, the board, the third party doing the attestation, like exposure just seems to have gone up dramatically in all this. Is that fair?
Yeah, and if you're the underwriter, you're going to be underwriting an offering, and now you're taking.
So this would be in an IPO document, for instance. You would have to have this.
Yeah. So the SEC wants this to be in all of your registration statements. If you're doing a follow-on offering, obviously your 10K is going to be incorporated by reference into that, or included in your S1. If you've got an S4 because you're doing a business combination, these are disclosures that are going to be wrapped up into that. So when you're thinking about who am I going to be doing that merger with, now I've got to actually consider these things beyond whether are they material and do they need to be disclosed. That also matters if you're going to be acquiring someone. So if I'm going to go out there and acquire a private company that hasn't gone through the process of making these disclosures in the past, just like with having to prepare financial statements 71 days after that 8K gets in, now you've got to make sure that you're going to be able to get these climate-related disclosures in there. And that may affect whether or not you focus on some assets as opposed to others.
So can you put, as a classic energy company, can you put in a risk factor to your business that you are not sure when overreactions, agencies, will wade into your business unexpectedly and impact your ability to finance and operate? That is a risk of climate-related activities, climate-driven policies. It's not a risk of climate. That's honestly the bigger risk to oil and gas companies than climate, is it not? That's sort of a
in many ways, right, this is Dan the cynic talking, but in many ways, to my point earlier on, this is specifically targeted towards energy companies. There's groups that have been pressuring this for an extended period of time, and they tried with access to equity and access to banking and access to insurance, and while they were successful, they weren't completely successful in cutting off in its entirety. When you put this in place, my opinion is that you open up the door to lawsuits, and now it didn't happen with equity, it didn't happen with banking, it didn't happen with insurance, now we'll just sue them out of existence. And I really think that that's one of the chess considerations that a group like Ceres or another group that is consistently pushing investors and the SEC on that. If you look at, for example, if you have a conversation with an investor, let's be honest, if the return is there and the strategy there and the management team is there are ESG considerations, but it's not necessarily just to check the box, but it's pretty close to a check the box. So if they say, yeah, ESG is the first thing I look at, I have a hard time with that because there is no magical pool of capital at the end of the ESG rainbow. It doesn't make sense. Like, let's look at how do you facilitate return? How do you facilitate growth? How do you facilitate innovation? Is the management team prepared to operate in a decarbonized world? Okay, if you can check the boxes on those, let's look at ESG and make sure that we can not check the box, but be comfortable with this. I don't understand why it has to be included in the legal sense that it does. Once again, speaking not as a lawyer.
No, look, I'm always glad to hear somebody's focused on litigation besides just the lawyers. That's always a good thing.
I'll stay in my lane.
No.
That's...
I think you're absolutely right. What are people going to do with this information? It's not material. They're going to say, well, then why'd you put it in there if it's not material? And you say, well, because the SEC made me. And they're going to say, well, if the SEC made you, then it must be important, right?
So now the problem, or there's a lot of issues here. If I'm any given oil and gas company, I might have a certain view of what my risks are. There's a competitor company to me which looks very similar, but it may have a completely different text, right? Like everybody is going to be thinking of their own, how they perceive it and how they disclose it and how they describe it. And then honestly, it's going to be the same for most oil and gas companies, but yet they're going to have different, or how's that going to play out?
It's going to be different. I mean, think about GAAP, right? We talked about this before. You have GAAP, then you go to non-GAAP financials in order to actually provide management's view of these things. Are those comparable across companies? Are your GHG emissions, are the assumptions that you put into those going to be comparable? We talk about this all the time, that with GHG, you've got different reporting regimes throughout the United States on a regulatory basis already. And the numbers that you're reporting to those are every single one of those going to be identical to whatever the final SEC standard is that people are held account to? And then the question is going to be, why are they different?
Right.
And it's reconciling and justifying each of those assumptions built into each of those programs that we're seeing a lot of questions about right now. Because ultimately, when you get to the point of attestation, setting aside that we don't quite know what that's going to look like from the perspective of what data your attestees are going to be looking for, how it is that you prove that up. And one of the things we've been working with folks on is really concentrating on how do we reconcile and tell that story. I mean, the data needs, setting aside what we've already been talking about throughout disclosure on climate, programmatically looking at what's required to be kept, how we keep it, and the decisions that each company makes on how they approach each of those programs, even the same programs.
Well, even on
becomes difficult.
Even on scope 3, like you're asking companies to track the behavior and tendencies and trends of their supply chain and client base. And on top of being an impossible undertaking and a costly undertaking, what I think is your comment on non-GAAP, I was having a joke in my head, like non-GAAP version of scope 3, if you look at what's going on in California where gas prices are ridiculous, and then the legislation, or there's legislation saying, well, why don't we put in rebate, some sort of rebate card or something like that. Okay, well, by definition, that company who is providing that respective oil and gas scope 3 just shut up because there's a legislative measure put in place to provide access to oil. Like the circular logic on this is something that is going to drive companies insane, and the amount of resources and the amount of time that it's going to take when they can just have the conversation with the investor base, right? If the investors want it so bad, they will ask. I don't think there's any shy investors that will do it.
And while I do think the proposal as is was intended for the scope 3 emissions part really to target the energy industry, law of unintended consequences, that really does open up a lot of areas for any number of other industries, whether it's consumer products, the like. I know Colin had some points on that we discussed that really kind of put it in context of where it is that not only is the energy industry going to draw that line, but every other consumer product manufacturer.
Yeah, it seems like energy may howl the most initially because they see it and they've been under pressure, but a lot of others will start to realize, this could be problems for us too. Mike, why don't you jump in?
Yeah, it's really interesting to me. It's like you mentioned earlier about Sarbanes-Oxley, and that was pretty much addressed to too large to fail type deal, and it feels like this regulatory issue is like too small to succeed. Yeah. Right, and so it seems like the natural extension and reality of this is just going to make the smaller players go aside, have to merge, and is that what Is that what we really want? Because that really kind of takes away the technology, innovation, and stuff of that nature. So how do you think that kind of plays out in the public domain?
I mean, that's to my point earlier, is like the unintended consequences is you will see companies either stay private or go private or consolidate. And you'll have like 3 or 4 mega companies where it becomes such an internal bureaucracy to get anything done. It will impede innovation and technology. Yeah. I think if you foster, once again, markets 101, foster competition, right? A variety of smaller firms focused on the energy transition. That's taking place now. You have Shell VC, Chevron VC, Baker VC. You have all these VC arms of the super major firms to where their funding in large part is contingent upon the financial success of the parent. So if you are constricting that parent or making them reallocate resources and assets, that takes away from the VC. Look at the portfolio of the VCs. It's hydrogen, batteries, wind, solar, right? It just takes a long time. And the ironic part of this is the SEC should be focused on facilitating a long-term perspective with the investment community, but this is very short-sighted. It actually, I don't want to say reeks, but now that I said it out loud, I'll use it, of MiFID II. If we look at the days of MiFID II, where that focus was how do we protect the smaller investor, right? Well, we will have these rules that overturn the dynamics of soft dollars. This should be something very sensitive to you. And what did it end up doing? It took away coverage of small and mid-cap companies and reallocated attention to large and mega-cap companies that didn't need any more research coverage, right? Small and mid-cap companies need, and you'll see that's analogous to what will happen here is a lot of smaller players will be pushed out, either more to the private or won't go public, and you'll have concentration and you'll just delay the long-term goal that you put in place anyway.
So I would kind of reframe that. I'd say that for the mega caps, they're already doing a lot of this 100%. And they have the infrastructure already built up. So there's going to be a little bit of shifting in order to make sure that they're meeting the SEC requirements. And they're going to need advice on, okay, how do you make sure that you have proper documentation and proper document process to avail yourself of a safe harbor and things like that, right? The small, within those, specifically to corporate venture capital, this is like the sustainability movement more broadly, going to drive more capital to those. I think that if you're HAL Labs or the like, this is something that helps when you're providing those disclosures so that you can add, hey, and here are the other things that we're doing to mitigate climate risk and the like, because there are two sides of this coin. There is climate risk, but there's also climate opportunity. And if you look at some of the trading multiples of companies that have a better story from a sustainability perspective, I think a lot of them do have a genuinely higher multiple. And that's why a lot of the companies in the oil and gas space, just focusing on that, have spent more money and have started moving into that and taking that more seriously. At the same time, we still need some companies, or at least there are shareholders that say, we want some of our E&P operators to be single basin. We want you to do this one thing, and that's what you're going to be doing. And they're not going to have either the resources or the stakeholder consent in order to expand into those other areas. And I agree with you. I think there's going to be a lot more consolidation there. And we've already gotten outreach from people that have said, well, I was thinking about going private before. Maybe this is
the right time to do it.
But you just raised something. Sorry, Dan. I was thinking, if I'm an oil and gas investor, I've gone through and let's just say I've found the company with the highest standards and the best returns and the best management and the best incentives. I've found the sweet spot. I'm very happy, and then and I'm rewarding that company with capital. This thing is going to come in, and the whole sector is going to get burdened and opened up to lawsuit. And then what you just said, the SEC is going to encourage them to do things that I didn't necessarily want them to do. Like, I was happy with what they were doing. I knew what they were doing, but now they're probably going to go into some new things so they can talk about the climate opportunity. Like, this is distorting. It seems like if you're an oil and gas investor, I already knew this information. This is bad for my investment.
So I'll challenge that. I'll say for an integrated oil company, where they're going to do everything, yes, they are going to think about capital allocation. If I'm a single basin operator, I'm not changing anything about my operations other than I'm going to try and be more efficient in the way that I produce and reduce my GHG emissions. But it's not like I'm going to say, well, we're not drilling anymore. We're not going to do that ever again. Or all of a sudden we're moving into battery storage and we're going to start building facilities across the United States. What you will do now is you're going to have to live to the word you used, with the burden of the cost and the distraction of this on top of what you were already doing. And the numbers show that this, even in the SEC's own estimate, this is not a small cost for a small operator.
Like in all these things, what we want to encourage is the cleanest, greatest, most disciplined oil and gas we can possibly find. And this thing is a broad brush. The sector will suffer.
I mean, above it all, I don't know, like you have a scope 3 data point, for example. What is the incremental value of that data point within portfolio construction? Is it that much more valuable to now you can make a better informed decision? Like, I don't think so, right? SOX is different because if you have confidence in the internal controls that the margin is the margin and the revenue is the revenue and the cash flow is the cash flow, like, okay, yeah, I have a higher degree of confidence in that. With scope 3, there's just so many unknowns and ambiguities that if I have access to it, now I can make a better decision. Like, I don't think that's the case.
How do you build that in any pricing?
Exactly.
Right.
Yeah, but companies are all, again, prior to the SEC coming out with this, people are thinking about this in the context of, again, you're the E&P operator and you're producing hydrocarbons. Maybe you don't right now have any kind of scope 1, 2, or 3 disclosure in your public filings. And frankly, your shareholders, they don't care. You're going to be putting out the disclosure. It's going to cost you a lot of money to do it. You're going to take on liability from the plaintiff's bar who, frankly, they don't actually need to own your stock. They just need somebody who's in your stock when this disclosure comes out. There's potentially a stock price drop. Now you've caught a strike suit. But when you think about it from a supply chain perspective, and that hydrocarbon, that you follow the molecule all the way to the end user, what I think a lot of people in the value chain are realizing is, these companies are getting these questionnaires. Hey, can you talk to me about this, and this from your even GHG emissions and the like? And all of the public companies are going to be able to, or going to be required to be providing this information to their investors. That's the same information that I think a lot of the folks further down the value chain will be requesting. And again, looking at it from an opportunistic perspective, if you already have been trying to improve your operations, maybe you have something that differentiates you as opposed to one of your competitors. Maybe not, to be honest.
Well, I'll give you an example.
And then that flows through to somebody who's trying to 2 years from now prepare GHG scope 3 emissions.
I agree with that, and to play devil's advocate, let's say from a scope 3 perspective, I'm a producer and now I'm in an area that has booming population growth. Right? So the chain of custody in terms of that molecule has not been defined.
Yep.
So if I am supplying municipal services, police officers, fire departments, and that city is booming, my scope 3 is going to go through the roof. If I'm from Chicago, so if I'm in a place that's witnessing massive population decline, then my scope 3 is going down. In of itself, you look at that and you're like, oh, that's great, but you're not taking into account 3 different things. Chain of custody with the life cycle of that molecule. Where does it pass? Where does responsibility pass on? Like, I don't know, like that's your guys' question. The other component too is all the external factors, both from a legislation and just from a socioeconomic perspective. Like, there are so many factors that will impact that scope 3 that is not being addressed nor considered in this regulation.
You're right. Yeah, we're in violent agreement.
Yeah, well, but
Violent agreement.
I think it goes back to a point Maynard made earlier, which is everything you're talking about in the context of those scope 3 emissions also has associated with it a societal good. I mean, whether it's as direct in terms of providing social services to I don't want to be picked up by a horse-drawn ambulance. Okay, I really want a gas-powered one.
not that
so
bad.
yeah, it did.
It would take 2 horses for me to get there. But here's Colin. We got to get you in here. But I think you guys, as you talk, this is awesome. But it's the fundamental, the thinking that you can blame the people who produce it, and let the people who use it off scot-free. Like that mentality, that's my point about the SEC used oil and gas to make these regulations. That mentality that creates an us and them. There's no us and them. We're all in this together. It's just really...
Once again, big picture consideration here. The SEC's role is predominantly, above all things, to maintain the credibility and the integrity of the capital markets. Yeah. We are already littered with financial crime. Like, there are financial crimes all over the place. Like, just a couple statistics, one on the SEC's website, 697 total enforcement actions in 2020, right? That was 7% jump from 2019. So my concern, big picture wise, is the SEC is already incredibly constrained, right? They don't have an unlimited amount of resources. And if there's Ponzi schemes running around and AML considerations running around and all these other, like I went over the key priority areas of the SEC, and I won't do that. I won't make you, but like, are we misallocating attention on climate? And I'm not saying it's not important. I am saying it's important, but is it at the expense of all these other focus areas that maintain the integrity and the efficiency of the capital markets? That's a major consideration.
I think you're on the issue of the last however many years, which is when we try to make policy where the only thing that matters is climate, we not only make bad policy, we don't help the climate.
Right.
And this is the really sad part, I think, about so many climate first people, is they're not helping their own cause.
I mean, if you're a climate first person, respectfully, God bless you, but go to India and Brazil and China, right? I think, there is, once again, empirically speaking, there is a correlation between renewable penetration and energy affordability. Last time I checked, we're in a recessionary environment where purchasing power amongst the American consumer has remained steady for like 30, 40 years. If energy increases, and I know Colin said we're not heading into a recession, but in the not too distant future, just by the cycles of the market, we will. Like, there's all these other external factors that we can really shoot ourselves in the foot if we're not careful.
So guys, we started about this has been awesome. It feels like a Thanksgiving, without the turkey and the wine. But if you're a concerned citizen or company right now, in any industry, but obviously we know a lot of the classic energy guys, what can you do to be productive right now? Is there anything you can say? Is there should the industry come together and say, we propose these 5 things instead of your 25? Or is there some move that the practical center of the world should make right now to try to make this end in a better way? We've never had a letter writing campaign out of COBT, but what should be done?
I think it's getting back to first principles on what it is that the SEC should and shouldn't be regulating. And it's part of what Dan was just talking about. And I'll use a term we threw about a little bit earlier, but staying within their lane. And I think to the extent that the industry does move forward and explain the importance of climate, but at the same time, understanding that regulatory scheme rests somewhere else. Mm-hmm. And if we put it in context, what it means to be material from a financial perspective with a company is fundamentally different. We can all agree that climate change is a material issue for the world. Whether or not it plays out as a material financial issue in any particular area, that's what we need to be focusing on.
Look, as an observer from an outsider in, I came from, the stock exchange world. I was at NASDAQ for almost 9 years.
I also didn't mention you're an adjunct professor at Marquette.
I'm an adjunct professor at Marquette in sustainability, right? I'm probably going to get 0 registration for my next class after this webinar. But I think, once again, observing, energy is amazing at execution and horrible at storytelling. The technology space, where I was predominantly coming from because of my experience at NASDAQ, is okay at execution, generally speaking, but amazing at storytelling. Like, not to be fair, energy over the last decade has done a terrible job of telling their story. And for the most part, they've been incredibly standoffish on any sort of, even if it's unrational, any sort of detractor narrative. What energy needs to do, if I'm asking that question, is write a thoughtful, comprehensive, and empirical response and comments to the SEC. Will it be the end all be all? Probably not. But it's going to be way better and more effective than just sitting back and saying they don't know what to do. I'm going to hedge my bets with an administration change. If you read the comments, and once again, I did that, and I can't believe it. It's scope 1 and scope 3, we need it. Okay? Doesn't tell why, doesn't give data. Be very thoughtful, be very empirical, be very objective on those comments, and stress the point that energy and energy transition are not mutually exclusive. They're intertwined. They need each other.
Well, and we need, you were talking about this a little, Scott, but we need other industries to realize, even if this has implications for more than just energy, it has, implications for the country, for their industry, for all kinds of things. So, well, you guys have been fantastic. It's hard to end this conversation, but it's been a robust one. We didn't expect we would come up with the exact answers, but I think as we wrap it up, reading those commissioners' comments, Commissioner Lee and Commissioner Pierce, you really get a sense of it. We'll attach the Baker-Botts memo on this. And look, I think I loved your comments, Dan. The world needs to work on the energy world needs to work on its messaging, and there probably should be a pretty thorough, thoughtful, reasonable response to try to get this going in the right direction. I'm looking at you, Dan. We might make you scribe.
That's fine with me. I'm a fast talker, equally as fast writer.
Awesome. Well, thanks, everybody.